Welcome back. Time now for the word on Wall Street. Top investors watching your money. Joining me now is MJP Wealth Advisors President Brian Vendig. Also with us is Harris Financial Group Managing Partner Jamie Cox. Gentlemen, great to see you both. Thank you so much for being here. Brian, I want to kick things off with you with the market that has a firmer tone once again this morning. And once again, we're looking at the leadership within tech and financials. The Dow Industrials right now up just 10 points, but look at the NASDAQ. It's up 133 right now, 0.5%, after all three major indices ended higher yesterday. Once again, driven by chip companies and the banks. Chip stocks rallying after Taiwan Semiconductor smashed forecasts with an increase in fourth quarter profits of 35%, signaling renewed confidence in AI-driven demand. The U.S. and Taiwan also announcing a new trade deal. Taiwanese chip makers will be investing at least $250 billion into the United States to expand production in America, including potential new facilities. In exchange, the U.S. is lowering its reciprocal tariffs on Taiwan to 15%, while incentivizing more chip manufacturing on American soil. Brian, your thoughts on the trade deal, as well as this strong demand for AI continuing?
Yes, good morning, Maria. I think this year in 2026, we're still going to see a renewed outlook for AI innovation over time. Obviously, since the end of October, definitely a little bit of a pause. But, Taiwan Semiconductor's earnings this week was a great signal that demand is still there throughout the supply chain. And this trade deal helps to, I think, assure that the supply chain is secure from a global perspective with more renewed investment in the United States. And obviously trying to create an equitable trade deal to preserve these assets. Now, moving forward, I think you look at the breadth of earnings for the year. Expectations are 15% growth year over year for the full year 2026. Financials definitely started the year off strong. We've seen some strong reports from names like Goldman Sachs and Morgan Stanley yesterday regarding M&A and advisory revenues increasing. And I think it's still a good story, big picture for financials with a steepening yield curve, the M&A environment, and the IPO market potentially heating up. So looking at a balanced view on equities, Maria, between tech and cyclical sectors like financials, industrials, healthcare, I think makes a lot of sense this year.
Yeah, and of course, we're right in the middle of earnings season now. I mean, Jamie, Wall Street's major banks delivering nearly $600 billion in revenue last year. Trading revenue led the charge with a record $134 billion haul. Executives say that the setup remains ideal for more gains ahead because deal making and lending also drove results, and that's expected to stay strong in 26. Banks are flagging geopolitical risks, elevated asset prices. Goldman Sachs is exploring opportunities in the prediction market. CEO David Solomon met with leaders of major platforms, signaling growing institutional interest there. And I've got this item this morning over at Piper Sandler this morning. Jake Ubino, who's a friend of this program, regular guest, he highlighted that households will very likely spend at least 70% of their nearly, get this, $200 billion 2026 tax windfall of higher returns and lower withholding, with consumption risks skewed to the upside. So we're going to probably see this spending surge hit, Jake says, after the tax refunds roll in, concentrated in February and March. That has to be a positive with all that tax refund money in people's pockets, Jamie.
Well, it's not just that. I mean, you have the president who has all three economic levers on go. You have monetary policy, being very accommodative. You have fiscal policy, which is in place. And you've got credit coming from the Treasury Department and, also in other forms where it's being, really slanted toward consumerism. I mean, we're going to see an economy that is actually going to boom this year. It's already started. You saw like GDP reports in December. You're right, Maria. There is going to be an enormous amount of spending. We see it here with our clients. I mean, people are doing projects, buying vehicles, basically doing things that they had been reluctant to do over the past couple of years because they were afraid of what was going to be with inflation. What were they? They were having to spend so much money on basics. They were afraid to spend money on other things that they wanted. And that's really changed in a big way over the last couple of months. People feel a lot more confident about their financial circumstances. Housing values are good. Their stock market portfolios are good. The wealth effect has come back in a big way to the average American. And they're using that power to actually go out and enjoy it. Travel is really doing well, Royal Caribbean, others. You're really seeing it, and the tax refunds are just an extra piece of it. It's not really the base of the spending surge that you're going to see. So I think just looking at it from a market's perspective, how about those small caps? I mean, they have beaten the S&P 500 10 sessions in a row. That's the kind of things that you see in the marketplace when consumers are really strong. And I think that people may have it wrong on giving the dollar the last death knell. I think people are going to really be regretting, thinking that the dollar is on its way out. I think the growth matters for the price of the dollar. And I think the dollar will probably have its resurgence in the next little bit.
Yeah, I mean, you have to ask yourself, what is the alternative to the dollar, right? I mean, the alternatives are not very attractive, by the way. But I love this idea that, the Big Beautiful Bill is really underlining all of this. The Big Beautiful Bill and its impact is going to have a big impact on the economy. We're talking about 5% growth expectations right now. And like you say, the cherry on top of this cake is this tax refund. I love the idea that we're going to look at nearly $200 billion in 26 tax windfalls in February or March when people start getting these checks, and they're going to spend, according to Piper Sandler and Jake Ubina, they're going to spend 70% of it in February and March. That's going to be extra money. Story stocks, guys. Paramount escalating its push to acquire Warner Brothers. We've got this hostile bid underway. A Paramount meeting with French President Emmanuel Macron and UK officials on this. This is a $108 billion hostile bid facing scrutiny as Paramount battles Netflix for the studio giant. A Delaware judge refusing to fast-track Paramount's lawsuit against Warner Brothers, keeping that deal timeline in check ahead of a shareholder vote. Brian, your thoughts on this? Look, Warner Brothers has made no secret of the fact that it wants to merge with Netflix, not Paramount. But Paramount's price and what it's willing to pay looks better, $108 billion.
No, Maria, you're right. On the face of it, it looks better. But I think the concern that the board at Warner Brothers Discovery has is the fact that some of that increase in price was backed by debt and the concern of liquidity to be able to fund that deal. Now, earlier this week, it's been reported that Netflix might be increasing their offer and actually making it more of an all-cash deal, because Netflix came in originally with a 85% cash, 15% stock deal. Right. It's possible that they're going to raise their cash offer, and this is just going to continue. And also keep in mind, Maria, last point here, is that the termination fees, if this doesn't go through, are in the billions of dollars for both sides. So I think this is going to still face a lot of scrutiny from our friends in Washington, but we'll see how this all plays out.
Yeah, it's a great point. Of course, the Paramount bid is already all cash, so we'll see what Netflix comes back with. Brian, great to see you. Jamie, great to see you both. Thank you, gentlemen. Brian Vendig, Jamie Cox. We'll be right back.